Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Sarah Hunt of Alpine, Saxon and Wood saying this: just when you think you can make a case for a summer cut, in comes the jobs number and takes it off the table. While that noise we all heard is likely the sound of the door closing on July, the inflation numbers will add or detract to the evidence being used by the competing yes, they should and no, they shouldn't camps. Sarah's with us for more. Sarah, good morning to you.
Good morning.
Never mind good news, bad news. What was Friday? What was that?
I think it was mixed news, right? So you start to have all these discussions about the differences between this survey and that survey, and can we count on this, and what is the birth-to-death model doing? I think it just is indicative of the fact that it's a confusing market, and I think that that is on the labor side, certainly, and I think that that's part of what's coming into play as we go forward. We started off this monster rally when the Fed basically said at the end of last year, or the October of last year, we're done raising rates, there's going to be an easing cycle. People built in a ton of easing, and now people are looking at maybe taking that away. And I thought that Lori Calvasina's note this morning was really interesting on, if we don't get one at all, you've got some weakness in the equity market.
I know Lisa's got thoughts on that, but before we get there, if the payrolls report slammed the door shut on July, can Wednesday morning reopen it?
Wednesday morning could reopen it because, as a number of people have noted this morning, it's not just the labor market that the Fed is looking at. If the inflation really looks like it's coming down, but to your point earlier, the housing market is not getting any better. Rents are not coming down. They're not looking a whole lot cheaper, at least not in urban areas. So I think it could, because you have that discussion of, are we cutting rates or are we normalizing? And obviously the market's going to take any cut as a start of an easing cycle. But if they can do something like the ECB did, which is basically say, we're normalizing, but we're hawkishly normalizing, and we're not going to cut. Don't look at this as a cycle. It could certainly open it, but I don't think to July. I think it opens it later in the year.
On the flip side, if we get a hotter than expected CPI print, you were talking about Lori Calvasina's call, this idea that if there are no rate cuts this year, it could cause an 8% decline in the S&P 500. What if Jensen Huang comes out later this week and says that he has a new development that's going to build robots that do our dishes and take care of our children? Could that totally change any kind of sell-off?
Well, I think that there's already been a bifurcation in what a sell-off means. NVIDIA has not been part of any of that sell-off. You've seen other tech sell-off in ways that NVIDIA has not. There is a secular story there that is difficult to say that whatever is going on with the Fed is going to be important for that piece of technology. But there's also a big future element, and I think that that's what people are starting to recognize, is that you have to really go further into the future to try to monetize this, unless you're NVIDIA and you're selling them the chips right now. So there's a little bit of a thing going on right there where there's a secular story in one part of technology, but a market story in the rest of technology.
And do you believe that we're currently at rates that could cause the market story to gain legs? Like if we stay here, for example, in the market, I'm not just talking about Fed funds rate, that could really crimp how people understand forward-looking profits for a lot of the companies in the other 493.
Interestingly enough, I think it's almost less about profits as what it does to things like the housing market, which is still pretty stagnant, and what it does to people who have been waiting for a chance to refinance, because the idea was we're going to hike, we're going to go very high, then we're going to come down quickly. That's not happening. So there's a lot of extend going on in some of the fixed income markets. And I think that whether or not the stresses start to be a part there, I'm less worried about the larger cash-rich companies on whether or not a higher interest, a 5% versus a 4.75 or 450 makes a big difference. But if you don't get a cycle coming down, there's a lot of areas where I think that there's some tension in refinancing.
So let's get into it. Places you want to be, places you want to avoid. What are they?
Well, I think you need to be in the part of the technology sector that's quite clearly throwing off buckets of cash and doing really well in almost any environment. I think it's hard to say that that's a place you want to stay away from. The oil picture just got more difficult for energy. And I think that that's still something that is throwing off a lot of cash, throwing off a lot of dividends. You've got good buybacks there. Retail's very difficult right now. You've seen a bunch of retailers come out and say, year-over-year sales are not doing that well, and we're kind of worried about the next couple of quarters. So there are areas where it's quite clear that there has been a slowing. And there are areas where there may be some acceleration, but the overall economic picture is going to weigh on some of those materials and energy kind of stocks. Some of the industrials are doing quite well and going to continue to do quite well. It's very pick and choose right now.
You hinted at something, that the longer rates stay at these levels, there could be some real credit stresses that percolate into something different. Can you give us a sense, walk us through what that looks like? How severe could that look? Is that a credit crunch? Is it a sudden plunge? Or is it just sort of a slow bleed on economic growth that just becomes more and more evident over time?
So I think that one of the reasons that you've seen, I mean, there has been some equity volatility, but not the kind of volatility you would expect given some of the things that have gone on with interest rates over the last couple of years, is that we've had all these government programs that came through in the financial crisis that people now look to say, you know what, if there's a really big problem with interest rates, there's going to be some sort of program to help them, right? So the whole issue with the banks that started last year where the Fed said, okay, or Treasury said, you can go put us collateral at 100 cents on the dollar, even though rates have gone up and that collateral may not be worth 100 cents on the dollar. There are a lot of programs to deal with that. So I don't know that it's as much of a crisis as it would have been in past eras where you didn't have a kind of backstop on some of that. So I don't know where that goes, but you've seen commercial real estate have problems. You've seen even apartment housing. There's certain parts of the real estate market that are really showing some stress, and those are long assets. And a lot of those were financed at times where now if you have to refinance anything, you're looking at a much bigger number. And if what you paid for that asset is now problematic relative to where interest rates are. So I think that there's a question of what those assets are worth, but I also feel like there's an underlying feeling that there will be something if it gets really bad.
So just to sum this all up, and Jon was asking what you like and what you don't like. You do like big tech and companies that are just generating bucket loads of cash. Consumer cyclicals are a little bit questionable. How cautious are you, given that you just don't have visibility at a time when you also are charged with generating alpha?
Well, it's tough because you have a multiple situation that, I mean, if you take the, to Peter Cheer's point, the top 10 stocks, 35% of the S&P, but you have a multiple issue in some of the other areas. And I think you have to be careful both about what you pay and what everybody's balance sheet looks like, right? This comes back to cash. Am I generating cash? Because if you're not, and or if you have any refinancing that you have to do, you have to be quite difficult. It could be quite difficult, so you have to be careful about that. So I think that you just really need to pay attention to valuations in a way that we really haven't had to in sort of a while, because you just now have more vulnerability on what happens with the rest of the financial picture and what happens with interest rates.
We started this hour and we were talking about politics, and I could see you out the corner of my eye nodding along. 25. Have we got a clue what the next year has in store for us?
We do not.
How difficult is that as an investor?
It is difficult, but if you take the politics out of it and you say how much has the regime changed in terms of what that means for the equity markets, as long as you're not radically changing tax policy or you're radically changing a lot of the tariff policy. I mean, there was supposed to be a big switch when Biden took office about what was going to happen with China. It didn't really switch that much. There may be a change in immigration. We'll see what that could happen to the labor markets if you get a change in administrations. We don't know enough yet to start trying to figure out what that playbook looks like. And I think that's going to be very difficult to parse.
So do you shorten the time horizon, make really tactical calls, or just assume that things carry on as usual and there's no big change?
I think we're always looking for a longer picture, right? We're not very short-term traders. We're looking for a longer picture. This goes back to, am I generating cash? What does my balance sheet look like? What is the economy going to do? You look at the macro picture more because the political picture is going to change, and we just don't know how that's going to change.
Sarah, this was great. Sarah Hunt of Alpine, Saxon, Wood. Rubeela Farooqi of High Frequency Economics writing this: while incoming data will ultimately drive rate moves, our base case remains that the Fed will make the policy stance less restrictive this year in response to a slowing growth and inflation backdrop. Rubeela is with us right now. Rubeela, before we run away with this week and start on Wednesday, we need to start with last Friday. Do you believe that jobs data Friday morning overstates the strength of the US economy?
The jobs data show us that this economy is still creating, jobs at a very fast pace. This is something that, if you look at the underlying trend, though, we're not really seeing a breakout either to the upside or downside. But the U.S. economy is still creating a lot of jobs. It's the household survey where, there's a little bit more of a concern. The unemployment rate ticking up, still very low by historical standards, still in line with where, the Fed marks the longer run rate. But this economy is still very strong. The labor market is very supportive of incomes, of households, and we continue to see that.
In the numbers, if you take them at face value from Friday, we saw wages increase at a faster pace month over month than many people expected. Right. Yet you say that the data are pointing to little threat of inflation from labor costs. What gives you that conviction?
You know, if you look at the average hourly earnings number on their own, yes, there's a reacceleration that we saw in the latest numbers. If you look at unit labor costs, and, these data are extremely volatile quarter to quarter. But if you look at the underlying trend, we have seen, if you look at the year-on-year changes, we are seeing a consistent improvement in productivity. And, if you look at the revision to the latest numbers on unit labor costs, a consistent deceleration in unit labor costs. Also, if you look at other numbers, right, we are seeing sort of mixed signals. So I don't want to overreact to 1 month's number. If our base case is that economic activity is slowing, that demand side of the economy is slowing, especially in the services sector. If you look at the services spending numbers in the latest 2 months, that is slower. The problem is that we've seen this before, right? We see a slowdown and then we see a rebound. So what we're looking for is a consistent slowdown. The early numbers are certainly suggesting that. So we're not expecting a reacceleration in economic activity. We've already seen a step down in household spending. It's just a matter of some more evidence, and the Fed is also looking for the same.
Can you frame how important then CPI is going to be on Wednesday in terms of either supporting your thesis of a gradual slowing but also disinflation versus sort of rejecting it?
Right. The CPI data, we expect them to show what the PCE data is showing, right? The inflation is sort of moving sideways, really not much of an improvement right now. But what we are seeing is a deceleration, a deflation in goods prices. The services side is where, all the problem lies. That's what's boosting prices. In, the CPI versus PCE, you've got that housing component, which is much weightier in the CPI numbers. We do think that is also going to come down, but gradually. And we also think that this, ex-housing component of core services, that is also something that we're watching very carefully. And all indications are, if you see services spending, sort of moderate, then you would expect that, as that demand slows, that those price pressures will also abate. But if you look at, there's conflicting evidence, right? If you look at some of the numbers on travel, on entertainment, those numbers are still, they're still signaling that there is staying power to the services side. But we do think that we're going to see, over coming months, a moderation. The whole idea is that the U.S. economy continues to grow. The Fed has delivered over 525 basis points of tightening without causing a recession. They're going to be careful as they move forward. We think the base case still is that the U.S. economy grows, but it slows down. The momentum decelerates.
Rubeela, appreciate it. Rubeela Farooqi there, High Frequency Economics, looking ahead to Wednesday, a Fed decision and the data in the morning. Joining us now is BlackRock's Amanda Lynam alongside Zandi of Moody's Analytics. Let's set the stage like this. There's two surveys that go into the jobs report. Amanda, you know them well. Two very, very different stories. What was Friday about?
Well, I think just taking a step back, as you noted, the overall establishment survey showed really strong momentum. Perhaps that might have been driven by some of the immigration that's coming into the country. The household survey showed a pretty meaningful decline, but that was really in folks that are under the age of 25. So it was really concentrated. And I think we've spoken about the bifurcation in the economy in sessions past. I think that's partly what you're seeing there. But in aggregate, as Mike noted, the economy is still chugging along, even if we expect some deceleration from, say, where the Atlanta Fed GDP now is. Say we end the year at 2%. That's still trend or above trend growth. And I think for us, the shallow rate cutting cycle that we're expecting is really a product of that, because it's not obvious to us that there's urgency for the Fed to ease. We expect them to normalize, but not really to ease policy.
Zandi, two very different surveys. From your perspective, would you put more weight on one versus the other if you're sitting on that FOMC?
The establishment survey, the survey of businesses, I think that's the better measure. I mean, it shows the job market's strong, resilient, creating lots of jobs. The job growth is very broad-based. But you can't dismiss the household survey and the increase in the unemployment rate. It does indicate that the labor market is really cooling off. If you look under the hood of the job market, hiring is weakening. We're seeing fewer quits. Unfilled positions are declining. Number of temp jobs are declining. Hours worked are declining. So, the job market's okay. It's fine. It's moving forward, but it's cooled off. It's, exactly where the Fed would want to see the labor market, resilient, creating jobs, but, not at a point where it's feigning inflationary pressures.
Dialing this weird aspect of the jobs report into what we're expecting in terms of CPI on Wednesday, Mark, are we measuring inflation correctly?
Well, yeah, we're measuring it, but there's all kinds of problems with it. I mean, if I were king for the day and at the Federal Reserve Board and looking at the inflation measures, I'd be focused on something that's called the harmonized inflation measure, or harmonized CPI, or harmonized PCE. That's everything except owner's equivalent rent. That's a mouthful, but OER is this implicit cost of owning your own home. That is very problematic. I've learned a lot about this, digging deep into it. It's very problematic even when things are going well, the housing market is well functioning. But as you know, the housing market's a mess. We've got a very severe shortage of affordable housing. We have a surfeit of high-end housing, and that's a scrambling thing. So if you really want to get a sense of underlying inflation, my view is you use harmonized. By the way, that's what's used in the rest of the world. And if you do, it shows that, mission accomplished. We're there. Inflation's back to the Fed's target, and it has been for quite some time.
Amanda, picking up on that point, I'm glad that Mark brought up the housing market. We heard this from Sarah Hunt also, that this is actually completely skewing a lot of the measures that we're looking at because the housing market's broken. And this is a key aspect of the U.S. economy and input into inflation. How much are you watching that and sort of using that as a gauge of credit strength more broadly?
Yeah, it's part of the reason why we like to look at the supercore, which is the services X housing. We're looking at a range of metrics when we're looking at the degree of restriction of monetary policy. I think from a pragmatic view, we're not expecting major changes to the Fed's inflation targets or the reaction function. I think they need to get to their target before they even think about kind of reevaluating whether or not these metrics make sense in this new cycle. But from a credit perspective, we're not seeing a massive degree of restriction across the credit landscape. We're seeing it in pockets, but we're not seeing it widespread. And so there are certain areas where, sure, borrowers would love to have some rate relief, but is 25 or 50 basis points going to move the needle for them? Probably not. And it's really the depth of that cutting cycle that really matters for risk appetite. But I think the good news is that most of these corporates are managing this backdrop in a resilient way. It's largely a function of growth, however. If we have a significant slowdown in growth and we have persistently elevated cost of capital, I think that's where we could become much more cautious.
Have the sources of finance shifted? We've talked a little bit about this over time. Does that make it more difficult for the Fed's policy to really get to maybe where it needs to go?
They have shifted in the sense that you've seen private credit play a bigger role, but even in the syndicated markets, we're seeing significant demand for leveraged loans, both from investors and for borrowers to issue there, because the demand is so strong. CLO creation is high. There's a lot of technicals are really important in the credit market. But I think, yes, the sources of financing have kind of helped out a bit, but in general, the tone is just still very strong. And I think part of that is a function of corporates entered this period from a position of strength. But again, the growth has allowed corporate credit to absorb the higher cost of capital. I think it really hinges on growth. Even on Friday, the yield back up, we saw buying in IG credit, right? We saw investors coming into the market when we had a 15 basis point back up in yield. So it shows you the strength of that demand is really there. So it's hard to get incredibly negative on corporate credit spreads because even when it tries to sell off, you see either in spreads or in rates, the buying comes in.
Mark, it's really difficult to reconcile the conversation we have on Wall Street with the conversation you hear from FOMC officials around the issue of financial conditions. Can you tell us what is the difference between a Federal Reserve official saying financial conditions are tight and people on Wall Street still saying they're easy?
Well, I think they're right where they need to be. If you point to the equity market or the credit spreads, it feels like conditions are easy. But if you look at bank lending standards and the banking system in general, not so much. Credit is much tougher to come by. So the value of the dollar is strong. That's consistent with tight financial conditions. So if you add it all up and mix it up in a pot, feels like financial conditions are right where they need to be. So yeah, you can find things that show that they're easy, some things that show that they're tight, but all in, it feels like, again, the Fed's got financial conditions exactly where they want them.
At this point, though, Mark, how much is this boiling the frog? And this has been sort of one of the questions with the long and variable lags that, we're sort of doing damage under the hood that's suddenly going to come to the fore. And that was the belief earlier this year. It was a belief last year. And then people abandoned that, said actually things are just fine and we can live with rates right here. Do you have a sense of which it is, of where the balance of risks is in terms of holding conditions at this level for just a longer period of time?
Yeah, well, the most likely scenario is the Fed's going to pull this off and the economy is going to soft land and they'll start cutting rates here pretty soon and, things will settle in. But I do worry that they're holding on here too long, that's too high for too long. The labor market has signs of weakness. I went through a litany of those. The financial system is fragile, it feels to me. I mean, the yield curve is inverted. Short-term rates are still above long-term rates. That's not, consistent with a well-functioning financial system. That, it's a very uncomfortable position to be in for the system. So I've got this image in my mind of the system as an engine, and it's shaking tremendously under the stress of these higher rates. And so far, it's held together with a little bit of duct tape and some help from the Federal Reserve and banking regulators, but for how long and why? Why would you do this? I mean, I think mission accomplished. I mean, full employment, 4% unemployment rate, inflation's back at target, properly measured, and has been for a long time. So why take the risk? So yeah, I do worry about that scenario. I don't think it's off the table, and I don't think we can take it off the table until the Fed starts lowering interest rates.
You wrote about it in the Washington Post. Note to Fed, it's okay to cut interest rates now. Sort of goes against, Mark, what we heard from Bill Dudley, who said the Fed thinks it's fighting inflation. Think again. How would you convince the Kashkaris of this world this week in a two-day meeting starting tomorrow? What would be the sort of cheat guide you'd say, you're wrong, this is the way I see the world?
Well, there's nothing that's going to convince anybody except data. So we get that CPI report. The consensus is that the core CPI comes in at 0.25, I think, to the second significant digit. And you need some 0.2s and 0.25s here over the next 3 months, and I think then you'll make believers out of folks on the Fed that they can cut rates. By the way, 0.25, you annualize that, that's just about 3%, a little bit over 3. That's on the CPI. You make adjustments because the consumer expenditure deflator is constructed differently. You're pretty close. You're within spitting distance of target. And by the way, we're still, I get it. We're slavishly holding this 2% target on the PCE deflator. I understand the necessity to do that because of the credibility and everything else. But really, at the end of the day, I mean, is 2% the right number? I think most people would say no, it's probably higher than that. So why sacrifice the economy to the altar of a 2% inflation target if you don't need to?
We've heard a similar argument from Mohamed El-Erian over the last couple of months as well. Mark, great to catch up. Mark Zandi there of Moody's Analytics alongside BlackRock's Amanda Lynam.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.